Do you agree with Gross? Do you think it's time to get into more tangible assets like gold and property?
I would also consider equities actually a tangible tangible assets. Yeah, but as far as bonds are concerned, where I would agree is that they look very, very stretched, basically around the world. Yeah, so we have pulled our overweight positions already a few months ago on U.S. high yield. We have just last month pulled one on European high yield, and we're also, as we speak, underweight in APAC. Investment grade versus equity. So basically around the world we have a clear preference around, on equity and no overweight positions left on bonds.
Okay, so you disagree with don't buy equities or we don't like equities, but you do agree with don't like bonds?
Yeah, correct. Yeah.
Yes. Okay, what about gold? Buying into gold and buying into property?
Gold, yeah, gold looks a bit stretched from our point of view. You know, it's a good diversifier against risk, etc. But with the notion that we're seeing inflation in the U.S. creeping up, not massively, but it is evidently, the trend is up. And if the Fed follows that trend, then gold as a non-interest-bearing investment is not terribly interesting at this point.
Okay. Hartmutt, something you and I were talking about in the break that I'd be interested to tell our viewers, you've done quite a lot of research into the situation in India right now. And you're saying it's looking a little bit more attractive.
Yeah, actually our biggest overweight, both in EM and in APAC, is currently on India. The key pillars here were really the developments on the earnings side. Yeah, so we are seeing for the second earnings season in a row now that year on year the growth is up. And especially sales, very, very promising, the sales growth here in India. So that's the main thing. But we're recently picking up also is that the politicians, or the government in particular, looks differently at the second half of their tenure. It's already been almost 2.5 years now than they have in the first. In the first, they were very, very disciplined, so rather tight on monetary, rather tight on fiscal. And we're picking up the first signs that for the second half of their tenure, they don't want to be as tight anymore. So as long as they remain reasonably disciplined, usually when you open up that bit, it's very, very supportive for the market. GST, of course, the big news for today. Wouldn't be surprised if it goes up. But GST, honestly, is something that has long-term benefits, maybe 2 years. But probably after 1 or 2 days, I think markets will say maybe that's a bit long. So we need to rely on these other pillars that I mentioned.